Bullish Banter. My name is Jesse. I'll be joined today by FX Special Lead Market Analyst Rufus Kamau, and we are covering a very interesting topic, that is the dollar liquidity crisis. And I believe you should be able to learn one or two things. If not, take opportunity of what you learn to capitalize on it. How are you doing today, Rufus?
I'm doing fine. How are you, Jesse?
I'm doing okay.
How is your liquidity index?
My liquidity index is definitely on the red. Yeah, it is definitely on the red. I need to do something, so I hope from this session I should be able to learn one or two things to react to it. Yeah.
Awesome.
Yeah. Now to the putting the bond first. Yeah, the dollar has been appreciating significantly at a fast pace compared to a lot of economies and currency pairs. Maybe a brief history. What has led to where we are at now, whereby the dollar is at least at 145 or even 140, depending on where you go, compared to the shilling?
I think we switched from an age of easy money.
Okay.
If we take it all the way back, we'll start with, let's say, the very first term of Obama.
Okay.
This is when they started suppressing interest rates.
Yeah.
They went really low to very close to zero.
Okay.
And US banks would get out of free money, which they would invest in various investments, including stocks.
Okay.
So we enjoyed some very good run, including Trump era,
yeah,
and up until COVID.
Okay.
So a lot of this money would find itself in various asset classes.
Okay.
Asset valuations, but the dollar was on the losing side. So
Yes.
the Kenyan shilling was pretty stable against the dollar.
Okay.
But then after COVID, this is when they printed a massive amount of money, which brought inflation way high to 9.1% in June last year.
Yeah, and in some economies, at least double digits, at least, or even worse.
Yes, for the UK, I think today they reported 10.4%.
Wow.
Yeah. So in order to fight the inflation, they jacked up interest rates way high from 0.25% in March last year to the current level of 4.75%.
Okay.
So they did it way too fast. This was the fastest hike in interest rates ever.
Okay.
And things began cracking. And I think the first crack was seen with the collapse of Silicon Valley Bank.
Okay.
Yeah.
So you say, first of all, the age of easy money.
Yes.
I am familiar with the name. I believe it's a documentary recently released by PBS. I think it's on YouTube. Yeah, very interesting. I think we'll touch a bit of what they covered there, but the other side of it. Now, the cracks have begun to show itself. And over the weekend of 17th, 18th, 19th of March, we have had a lot of releases from the different central banks to sort of address the scenario. Credit Suisse being the most significant bank after SVB to catch the cold of bank collapse.
Yes.
Are they correlated, or is it maybe their investment style is what the regulators need to check?
No, they are very correlated. It's a domino.
Okay.
So when there was easy money, a lot of these banks would buy US bonds.
Okay.
They were arguably one of the safest assets in the market.
Okay.
And they made a dumb decision to buy them at par.
Okay.
Because they could not sell them in the open market without making a loss.
Okay.
When interest rates went up.
Okay.
So bringing the conversation home.
Okay.
So as a result of the rapid tightening, the dollars became really scarce between last year and today.
Okay.
And by dollars becoming scarce, the other currencies in the world were losing.
Okay.
So some of the currencies that took a big hit include the Nigerian naira,
Okay.
Japanese yen, Kenyan shilling, and so on.
Okay.
So far, a lot of currencies are very close to multi-year lows against the dollar.
Okay.
And this is causing a lot of problems, especially in the global south.
Okay. I believe when you say these banks invested in one of the safest assets, this is a 10-year bond and plus, right?
Yes.
Is that theory being tested? The bonds being the safest asset classes, at least you can invest in?
People normally say bonds are the safest, but now we are realizing they are not.
Definitely. I think it has been this case at least since the time Benjamin Graham wrote his book around 1930s.
Yes.
And over the period until the gold was removed as a reserve has been causing some issues to it. I like to pivot a little bit before we resume back to this. There is some geopolitical scenario going on between, of course, the BRICS and the Western Front.
Yes.
And the BRICS primarily, that would be Brazil, India, China, Russia, and South Africa, primarily do hold the economy in terms of gold as a reserve with a bit of dollar,
Yes.
while the other Western world typically didn't rely on the dollar.
Yes.
Is it challenging or has some effect on what we are experiencing at the moment?
Yes. What happened during period?
Yeah.
The Chinese toiled for the world. You know, they ran their factories 24/7, and then they literally made around $2 trillion during COVID.
Okay.
And in the same time, the US printed around $6 trillion.
Okay.
You understand? Like,
Yeah.
you are working like you hard. Don't want to use that term. You're really working, running your companies. You know, everything you are doing to make $2 trillion.
Okay.
And then the guys who run the currency you are using, they can just print $6 trillion out of thin air.
Okay.
So they had to like sit back, rethink, and now they are trying to implement a plan
Okay.
to get off the dollar because they don't think it's a fair market.
Interesting. So these are things which we'll look to see how they unfold in the coming months. Hopefully, we come to a significant resolution that does not affect my pocket any further, right? Like I said, it is in red. We don't want it to go to...
I think it is still going on.
Okay.
Yeah.
Now, to the Kenyan economy, there are two things which have happened in recent past which are quite significant to the value of the shilling against the dollar. Number one, the government decided they would be importing oil on credit as opposed to paying in dollars immediately.
Yes.
And I think there is some clause at least to it.
Yes.
Maybe they'll be paying in Kenya shilling if Saudi Arabia would take it, right?
Yes.
And then the other one, they are putting the cabinet approved or removed rather the debt limit, which personally I do not prefer it in because it will be broken at some point, to a 55% to GDP ratio. Are these conditions set to alleviate the pain to a lot of exporters and importers, and as well most traders in Kenya, or it's a band-aid scenario?
Yeah, this is definitely a band-aid kind of solution. It's only temporary.
Okay.
You see, when you have a bill due,
Okay.
you don't have the cash, so you go to Fuliza and then you cover it. But
Okay.
the bill is still due. You still have to pay Fuliza.
Okay.
So it's the same thing. We are looking to buy oil. We don't have the dollars.
Okay.
So as a result, we kick down the can down the road and then look to pay later. So it's a strategy based on hope
Okay.
that eventually the dollar weakens and then we can be able to afford more dollars to pay for oil.
We see all these G7 banks actively engaging, either communicating to the markets or the government or general citizen population.
Yes.
While in Kenya, maybe it's mostly the government. Are they supposed to do anything, or we just wait for the big boys in the West to act first and then we follow suit and hope that whatever policies we have made actually complement the actions?
You see, you know that saying from Warren Buffett that it's only when the tide goes out that you know who was swimming naked.
Yeah, definitely.
So I don't think it makes sense to reason to the banks.
Okay.
They were literally caught swimming naked.
Okay.
Yeah, they bought out of bonds at par.
Okay.
Those bonds are inversely correlated. That is the bond prices versus the yield. Mm-hmm. So as the yield was going up, the prices were going down.
Okay.
And now, since they don't have the cash, they are pushing the Fed to cut interest rates so that at least they can survive this period.
Nice. Now, within Kenya still, the national Nairobi Securities Exchange.
Yeah.
I think it's one of those, can we say emerging markets at least?
Frontier
market, yeah. So we are a little bit lower, right?
Yeah.
Why is the NSE? I think right now we are almost at a 30-year low in across the NASI 20 index and the rest, right?
Yes.
What is causing this depreciation in company valuation? And I believe these companies fundamentally are not really suffering either from cash flow or even, the business-wise.
It has to do everything with the Kenya shilling.
Okay.
So at the beginning of COVID, that is March 2020, the Kenya shilling was trading at around 99 to 100 against the dollar. Today, the official central bank rate is 130, but if you really need dollars and you go to a bank or any FX bureau, you probably buy at 145 or even a higher amount.
Yeah.
So if you are a foreign investor, which are the guys who have been dominating the Nairobi Securities Exchange, then you know that things have not been running well.
Okay.
a devaluation of the Kenyan currency over the last 2 years by over 30%
Yes.
means that your investments in Kenya, if let's say you have a stock in Safaricom,
Yes.
the value of that stock in dollar terms has gone down 30%.
Okay.
So you are taking forex losses on top of the stock losses. So the only logical thing is to exit.
Okay.
So that's why we have been seeing the fall in the NSE.
Now, I think going with the quotes that you started with Warren Buffett, only when the tide goes out, you know who is naked.
Yeah.
He always prefers when there is blood in the street. Make sure now is when you are collecting as much as possible. And I believe he has been consulted a lot with the ongoing banking crisis in, the US and the Western front in general. You yourself have been involved in a lot of education within the financial markets. Would you recommend, now that investors are coming out, the prices are basically at a discount, to try and pick some of the companies which are performing well, at least within the NSE?
Bargain hunting is a tricky endeavor. It's more or less like catching a falling knife.
Okay.
So if a stock price is down, let's say 50%,
okay,
there's no guarantee it will not go down another 50%.
Yes.
I saw some guys buying credit shoes. I think down 50% and then it eventually collapsed.
Definitely.
So there has to be some form of fundamentals
Yeah.
supporting an overall turn of events.
Okay.
So if, let's say, Safaricom shares have been going down and now they are trading at 17 shillings per share,
Yes.
then there has to be something that changes fundamentally to support the end of the bear market.
Okay.
So you can either decide to do what you call dollar cost averaging,
Okay,
by buying small amounts consistently, but then you can also wait to see a fundamental signal to make a decision to enter.
a nice one. Of course, there definitely are political risks as well as you evaluate some of these stocks. Back to the Kenya shilling. You have told me recently that you believe maybe the Kenya shilling will go back to 100 against the dollar. What supports that position?
Personally,
Yeah.
I've been the biggest proponent advising people that the Kenya shilling will continue losing to the dollar.
Okay.
I speculated it will be at 130
Okay.
as soon as end of Feb. Ended Feb at 128, but eventually got to 130 in March.
Yeah.
So the thing is, the fundamental reason why I've been speculating the Kenya shilling will continue losing is because the Fed had committed to keep hiking interest rates in the US, and these would tighten the dollar further.
Yes.
They would see more dollar scarcity, and the Kenya shilling would continue losing.
Yeah.
But then, after the collapse of SVB, Silvergate, Signature Bank, we are seeing measures being taken by the Fed where they will be looking to backstop or basically insure all regional banks. And the amount of deposits that are currently uninsured in the US is about $17 trillion. So if they printed $6 trillion during COVID,
Yeah.
and a majority of this money is still in the system, and then they print another $17 trillion,
Yeah.
then that would be hyperinflationary for the dollar.
Definitely.
And in that case, we would see naturally the Kenya shilling starting to recover against the dollar.
Okay.
And as investments flow back to Kenya, remember these guys who have been moving out, they will find it more attractive to invest in frontier and emerging markets.
Due to the dollar devaluation against the local currency.
Yes.
Now,
so there would be a higher demand for Kenya shillings.
Okay.
And we would be seeing the Kenya shilling start to recover. Maybe we could even get back to 100.
humans do repeat themselves, right?
Yes.
Unfortunately. What you're mentioning, and I think from as well the documentary, there are some bits which are actually happening right now where most banks invest typically on 10-year plus bonds, right?
Yes.
And every time they do fail or something along that line.
Yes.
Is the theory that long-term bonds offering moderate return, 1.75 depending on the country, like US to 3%, safe?
Can you repeat?
Is it a safe investment avenue, given that it has been regarded as the safest you can ever put your money in, I think followed by gold or something else?
When you think of bonds, I don't think they are appropriate for young people.
Okay.
We technically describe them as dump money.
Okay.
This is where big pools of funds, such as pension funds, would basically park their money, knowing that this group of people are looking to, let's say, retire in 10 years. So we'll need this cash to pay them once they retire. So they put it in a predictable area where they know this is how much you will earn. But for a young person who is looking to build wealth, grow their investments, that's basically the minimum required rate of return in the markets.
So you need to beat it.
Yes, you need something higher. You could do SP500. That's still dumb. Maybe something that takes a little bit more risk, but has a high opportunity of giving you better returns.
Interesting. Going by that, any young person, myself included, who at least my equities are really in the red. I think right now we are sort of in a bearish market. The upcoming FOMC, or Federal Open Market Committee meeting, is set to basically set the tone for the long-term view of the dollar itself. Do you believe, maybe given that with more printing, there is the inflationary pressure, right? And the more they hike the interest rate, probably the system breaks at some point. So do you expect them to tone down on maybe the hikes, look at how give the markets a chance to at least adjust, or
I would say looking at gold prices, they have gone up 10% over the last 1 month. And that's an indication that there is uncertainty in the markets.
Definitely.
And when there's uncertainty, there's fear, there's panic. So all kinds of things happen in the markets when there's uncertainty. So the US Treasury and also the Fed are trying to normalize and bring back stability in the markets. So if they decide to go for a rate hike, be it 25 basis points or 50 basis points, then there will be a lot of panic. I expect the bear market to continue in US stocks.
I think there's been this sentiment in the markets a lot, and maybe I would like to pick your brain on it. Everyone is speculating what the Fed should do, and therefore making their investment or trading decision based on what they think they should do. Is that a healthy way of investing at this moment?
So far, it has been working with the policy of forward guidance. So every time they do something, they would offer forward guidance. They would say, if unemployment does this, if manufacturing does this, if GDP does this, then we will be looking to do this in the next meeting. So you would place trades to front run the Fed's decision. But right now, it's a little bit tricky because there's a new wild card, and that's the financial stability of the banking system. So if the Fed responds to the financial stability of the banking system and then decides to maintain rates at the current level or even cut interest rates, remember yesterday Elon Musk recommended that the Fed cuts interest rates by 50 basis points. And everyone was thinking this is crazy.
Definitely, it is not normal for just after sort of being hawkish, and then turn again to be dovish in your sentiments on what you believe the rates should be. So
you remember that meme where there's two buttons and Fed Chair Powell is trying to decide which one to press. So in this one, there's one button which is lowering inflation, and the other one is add more stress to the banking crisis. So a rate hike would add more stress to banking crisis. A rate cut would allow inflation to move higher. So in both scenarios, I think we'll be seeing a lot more dollars in the market.
So if there is inflationary pressure, I believe this would primarily be within the US, unfortunately.
No, the dollar is being used all over. So if there's more dollars flow here.
I'm saying the inflationary effect of having more dollar. If say there is more dollar, I think they are the first one to suffer because that is their legal tender. And Kenya will only benefit because inflation is going up there, unfortunately. And the dollar is weakening value, and Kenya shilling is now sort of gaining some strength onto it, right? So that is at least some of the theory behind your belief that at some point in the year, maybe there will be a lower value. Now, I think at the moment, as of Friday, we have a 3.6 month's cover of foreign exchange reserves, right? And it would be good, of course, to the listeners. What does that mean, and how can an economy or even a local investor use that information for their investment planning?
So by having 3.6 dollars worth of import cover, basically means we are broke. We are below the minimum, which is 4 months. So it's like, let's say your bills in a month is 200K, but the amount of money in your pocket is, let's say, 150.
Yeah.
Yeah. So, you're in a bad situation.
Either you have to pay, but
Yeah.
you don't have the money.
So the natural reaction is to grab some credit and then fill in the gap.
Okay.
The logical reaction is to cut your spending.
Okay.
So since cutting spending is not very popular in governments, you lose popularity, you start seeing demonstrations in the streets.
Okay.
You don't want to cut spending.
Okay.
So as a result, you go for some borrowing. And I think that's what we have done with oil. Where we are now buying oil on credit.
Yes.
So that we have some time to accumulate some cash in order to pay once the credit matures.
To sort of close on the Kenyan market scenario and pig it with also the quote on young people but would not be advisable to get into bonds market.
Yeah.
While the Kenyan bonds market have had a significant oversubscription, at least the last two issues. Maybe
Yes.
you can elaborate on that. What is influencing that desire as opposed to the other high risk, high reward, at least for a young person?
So looking at the market and looking at history, a majority of the people who have made money, and I think we covered this in the previous episode.
Okay.
For you to get really rich and create wealth, you have to invest in either your business or in someone else's business. So if you look at Warren Buffett, he invests in other people's businesses. For Elon Musk, he invests in his own business.
Yes.
So if you park some money in a bond,
Okay.
let's say the bond currently is earning 13 or 14%.
Yes.
Inflation is at what, 9.2%?
I think it's around 9.5 plus percent.
So now you're left with around 4% return on your investment.
Yes.
But then, in order for the government to repay this bond, where do you think the government is getting the money?
Taxation, of course.
Yes, it's raising taxes. So it's still taking from you. So the products that you will be spending this money on will be much pricier because the tax is higher.
Okay.
So it's also coming from your pocket. So you are basically at net zero.
On second thought, when I said my portfolio is on red, I think I'm following Warren Buffett, buying into a business and holding forever.
Definitely.
I think that is where maybe I would need to employ some of Elon Musk's entrepreneurial spirit, maybe to hedge against it.
So in terms of optics,
Yes.
you will feel like you have more money.
Okay.
But then when you go to spend this money, realize that you didn't make much from such a bond investment.
Yeah, coupled with the rise in price, of course, I think in fuel recently. So, yeah.
It would even make more sense if, let's say, you even get a very small percentage profit.
Yes.
Let's say last year you invested in a US stock.
Okay.
And this stock was giving you, let's say, a return of 10% in a year in dollar terms. But then when you're converting back to Kenyan shilling, there's even more gains because the Kenyan shilling lost a lot.
Okay.
So you would be up like 20-25%.
Okay.
So that would be much more sensible rather than a person who just parked money in a bond.
Okay. To what any investor would typically want to do at such a point. And I think I've read, and this is actually sort of something that is out there. Whenever there is crisis, people tend to pick some opportunities, and by luck or by strategy, they tend to make 1,000% plus on their initial investments. At this time, yourself as an analyst and looking at the markets, where should one be looking at? How should one maybe allocate his savings in a way that should whatever happen, especially the big word which people fear, the R word, occur, to cope with that?
So whenever there's bad news in the market, investors will tend to overreact to bad news and also to good news. So the common term we use is that bulls climb up the stairs, bears jump off the window.
Okay.
So if you are going on a very tall building and you take the stairs, it will take you longer to get to the top.
Okay.
But if you jump off the window, it can be real quick to get to the ground.
I think that is very evident based on 2020 and even recently when we had the SVB issue.
Yeah, the SVB collapse. So the thing is, when there's a bear market or when there's a panic in the markets, people will be very quick to sell assets that they feel are risky.
Yes.
And whenever they do that out of panic, shares can be overextended to the downside.
Okay.
And you basically buy them at a very good premium.
Okay.
So if you're looking at a business the way you mentioned.
Yeah.
It has good fundamentals. It's very competitive, and people have overreacted to the price. Then you can always grab that at a very cheap price.
Okay.
Yeah.
So analyze definitely using some of your, of course, teachings, at least on YouTube or even on Twitter, and see which company is going well.
Yeah.
Now, as we wrap it up, I don't know, maybe any word of advice you have for listeners because I know in the foreseeable months, still the banking crisis should sort of be evident.
Yes.
Is it safe to say invest aggressively or hold on to cash?
I think there's one step before you start investing.
Okay.
So I usually say invest in what you know.
Okay.
But then if there's something that you see that seemingly is attractive and you'd like to invest in it, then invest in knowing it first.
Thank you. Another thing which, just the last one,
Yeah.
You know, right now, and I think we have talked about it severally, the social media risk.
Yes.
You hear a lot of noise. It's like an echo chamber of bad news.
Yes.
And therefore, everyone jumping on it. How do you put that social media risk or factor it in your analysis besides the fundamental, technicals, financial, and the rest of any investment decision you make?
Yeah. I would say don't take advice from social media.
Okay.
Follow the right people, do your own research.
Okay.
Yeah. Whenever you see something trending, it's probably too late.
I think that is best place to end this session. Bullish Banter, it has been great, of course, to have you here. I know we'll continue to monitor and hopefully any person's input. Should you have a question, feel free to hit that on our social media.